When you listen to DeSantis talk about the bill, he said, gold and silver continue to move higher. So, when you add that in, like, for example, on the Glint app, at the end of the year, you get a statement from one of the big accounting companies that details what was a taxable gain and what wasn't, or a loss rather. But that's one of the issues with all of this gold and silver that is transactional, whether it be digital or not. You have federal capital gains taxes. So certainly it would be nice to, if he's right and President Trump does remove that, it's a huge boon for physical metals and physical metal holders. And we shouldn't be taxed. I mean, if I can go from Canada to the United States with 240 gold maple leafs on me and get through customs without reporting because that $12,000 face value at the time was valued at $9,700 because of exchange rates, they'd let me come into the country with 240 gold maple leafs, which are $50 face value, with no reporting. So the legal tender aspect is real. We shouldn't be taxed on it any more than if you had junk silver, dimes, and quarters and went and spent them at the Publix grocery store here in Florida and would be responsible for paying capital gains taxes. Although, it'd be difficult to track that one. The point of it is it just shouldn't be the case with legal tender. So I think that's certainly a worthy cause to get behind, and I'm thank you for having him on tonight with us. We continue to see this month over month over month. The amount of gold coming into the country is off the chain. It really is, and this was the largest delivery in a non-active delivery month ever in the history of the COMEX market. And we saw also, the same thing happen with silver, which is an active month. It was the largest silver delivery. But for gold, it was 25,401 contracts delivered so far. So if we take 25,401 times 100, that's times $3,250. All right, so that's 3. So that's 8,255,325,000. So almost $8.3 billion worth of gold was delivered. And one of the things that I read that was very interesting today was that there's 1 day left which is for the last notice of the May contract, and there's 526 contracts that are still open. What the author was basically saying, and let me give him credit too, just a second. Let me just look at my email. I want to give him proper credit. I read it in just this afternoon. I like to give credit where credit is due. I don't see it. Oh, Michael Lynch. Michael Lynch is very good. And he said that there's 526 contracts that are undelivered. It's one of the highest ever with the last day notice. Normally there's just a handful, if that, of contracts that have not settled. What he is saying is that this is an indication that a short does not have metal to deliver, as usually there's only a few contracts remaining at this point. I'm not predicting a default, as the short will almost certainly come up with some metal. However, this is an indication of short selling metal that they do not have. So yeah, it's a huge deal when you're seeing $8 billion worth of gold delivered. And in the March contract, there was north of 4 billion delivered. And every single month, we're seeing massive amounts delivered. This is an anomaly to the nth degree. So something big is happening with gold here in the United States and with silver, as May was the largest delivery of silver ever. It was also the second or third largest delivery of silver from a bank to a non-bank participants, from banks to non-bank participants, hedge funds, family offices, etc. There's big money, and it's not just the bullion banks this time. Who these participants are, I'm not quite sure, but something big is happening with gold and silver on the COMEX. It's easy for me to say that, right? The public should see this. Well, why should they see it? Well, the biggest deliveries in the history of the COMEX market are happening month over month over month over month over month. We started in November, and here we are, and it hasn't stopped.
When I hear people talk about capital gains on gold and silver, especially digital or app-based metals like what Santis referenced with the Glint app, I can't help but smirk. Yes, unless something changes, you'll get a year-end tax statement. You'll owe capital gains on metal you bought and sold. And that's ridiculous. Gold and silver have been money for millennia. Why are they taxed like speculative stock trades? Think about it. Canadians can walk across the border with 240 maple leafs. face value $50 each, and walk right through customs with close to $12,000 worth of gold unreported. That's legal tender, physical money, and nobody bats an eye. In contrast, Uncle Sam forces you to produce a broker tax form on digital metal held in a digital wallet. If junk silver circulated freely in Florida's grocery stores, would you get taxed? Of course not. That's money. So let me be clear, taxing gold and silver, especially when their whole purpose is to preserve capital, is an assault on economic logic. If Trump actually repeals capital gains tax on precious metals, that'd be a game changer, a huge boon for anyone storing real metal. I hope he does, not just for convenience, but because it legitimizes that gold and silver serve a unique monetary function. But the talk about gains and taxes is just background noise compared to what's erupting on the ground. Every month since November, COMEX has been hemorrhaging physical metal. May's non-active month delivery of 2,541 gold contracts, that's almost $8.3 billion worth, shattered all records. This isn't paper trading. This is bullion moving from vaults into hands. And silver? It posted its single largest delivery ever this past May, mostly shifting from banks to non-bank participants. That's families, hedge funds, asset allocators saying, enough chatter, give us the metal. Now, I don't claim we're heading straight to defaults. The shorts may scramble in at the last minute, source metal, and settle just before deadlines. But the market is speaking loudly and clearly. There is more paper selling gold than physical supply available, and the big smart money is pulling the trigger. And that March contract, remember, saw over $4 billion delivered. Now, May nearly doubled that. If this were a trickle, it'd be ignorable. But it's not. It's a tidal wave. And you know what's eerie? No mainstream coverage. Crickets from CNBC, Fox, Bloomberg. Yet these participation figures are the most important economic chart you're not seeing. I'm not trying to sound alarmist, but how often does $8 billion in actual gold disappear from vaults in a month and nobody talks about it? This is exactly what happens when the mainstream misses the plot. As Bob Kiyosaki told me once, people can't move until they see what's coming, and by then, they're too late. That's the point. What's happening in May isn't the first wave. It's the official crash alarm going off. But most people are numb. They're still watching CPI, employment data, earnings calls, none of which matter in a world where physical supply is being sucked out under our noses. Now let me level with you. There's a growing tidal shift in investor behavior. The first wave was central banks quietly accumulating. The second wave, which we began to see in 2024, is capital allocators doing the same, physically taking delivery. These are not paper trades. They're real assets. Someone out there is saying, I don't trust your promises. I want gold. And they're willing to pay the premium for it. When enough players do that, paper cracks, contracts stretch, delivery transforms, liquidation becomes inevitable. Look closely at the data. I cannot stress this enough. May was the monster month for silver delivery ever, the biggest move in COMEX history. So if you're watching silver ETFs or futures, you're watching someone else's illusion. Meanwhile, the metal is walking out the door, not with meme coin bros, not with day traders. Real money is going physical. And the public? They're not paying attention, still chasing quick gains in semiconductors or GMO-style zero DTE plays. But here's the twist. The miners are waking up too. For a long time, gold price went up, but miners lagged. Because in 2023, central banks were hogging metal and production costs rose alongside it. But 2024 brings a different story. Input costs have stabilized, gold prices accelerated, and margins are expanding. That's led to major producers, Wheaton, Agnico, Alamos, Lundin, seeing 50 to 100% share price jumps. That's not technical fluff, it's fundamental change. This matters to you because those moves in equities lag delivery. But when they start echoing physical demand, it's not a rally, it's a bull phase. Every prior gold cycle saw equities lag for a time, then rocket higher. I've seen it in the 1970s, the 2000s, and today I'm seeing the same patterns. The difference is in the shine. In past cycles, delivery was a background story. Today, it's front and center, bigger, louder, impossible to ignore if you just open your eyes. And that's why I want you to hear this. Owning bullion is foundational. Owning producers magnifies you, and holding liquidity keeps you ready. I'm still holding dollars and Canadian dollars, not because I'm bullish on fiat, but because I want options. When silver or gold pull back, I'm ready. When juniors roll, I'm ready, but my base case is anchored in metal I can hold.
Just in the month of May, Adam, we've seen a 700% spike in gold delivery from last year, same time, and which is May's usually a quiet month for gold. We've seen the largest delivery into the history of the COMEX market. Last I looked, it was over 16,000 contracts at 100 ounces apiece. People are institutions, whoever the heck it is, U.S. government, Treasury itself, I don't know. They're standing for delivery at a level nobody has ever witnessed before. 16,000 contracts, Adam, is $5.3 billion worth of gold.
Wow.
The largest delivery in the history of the COMEX market, not just in gold, but also in silver too. So there's a huge demand for physical holding of gold and silver. And you look at, the gold price that gets knocked down by $200, $100 for 2 days in a row nearly, and it shoots right back up. That's strength and resilience that I have never seen in 35 years. To me, the physical demand is overwhelming the paper price. And this is, I was reading something on X the other day, a comment, if you will, between Vince Lancy and Luke Groman. And, Luke said, now imagine what happens if it was the U.S. government bringing back that gold. And the response to all the commercial banks, because they were basically saying that it almost looked like a sell-only market, that they were a coordinated fashion, that they got together with the managed money and said, this is about to blow up the whole market. There is no more buying allowed, only sell only. And that's what he was intimating. And he says, in response to the above from the U.S. government is FU, he says. Send us more gold next month, too, and more behind for July, August, and September. And Vince Lancy says, it was, Luke, it was. No ifs, ands, or buts. You know it. Bullion banks to cover the Treasury, calling it back, or the Department of Treasury itself, it most certainly was. Now, these are two of the smartest guys in the world. And basically what they're saying is that it's the U.S. government bringing all this gold back in. And if you look month over month over month over month, in fact, let me, if you don't mind, just share one thing with you.
Absolutely.
This is just the month over month increase since last year. If you can see that, COMEX gold delivery. This is not something that is just an outlier in 1 month. Month over month over month over month over month. And really this goes back to November. Where we are, I would just simply say the biggest money in the world has been using any sign of weakness to stand for delivery and to accumulate more, and the price keeps going higher and higher and higher. It's not just here. You look at what's happening even in China too, and the numbers are off the charts in China. I think they bought the amount of gold that they just bought was an 11-month high this last month. So yeah. I think the best of what we could expect to see in gold prices is still, and silver, is still way in front of us. I don't know it off the top of my head, but I would think it would be minuscule at best.
Like single digits?
Not even. I mean, maybe even the other way, probably the other way, if I had to guess. And net exporter would be my guess, because, the previous administration had no affinity to bringing gold into the COMEX, certainly. So it would have only been trader based. This is something different. And this really happened since November of 2024.
And when we talk about the magnitude of this shift, it's easy to just focus on the dollar amounts. But we have to remember what's really happening is a spiritual divorce from the US dollar system. The world is saying enough, and they're doing it not with press releases, but with action. China, for example, bought over 225 tons of gold last year. They've now been net buyers for over a decade, and they're not alone. India's doing it. Turkey, Singapore, Poland, all in accumulation mode. They're reducing exposure to treasuries. They're reducing exposure to US paper. And they're swapping it out for the one thing that holds no counterparty risk, gold. That behavior doesn't lie. Think about it this way, these central banks have entire departments filled with Ivy League economists. They're not buying gold out of superstition. They're buying it because it's the only money that exists outside of this crumbling, dollar-based house of cards. That's not speculation. That's survival. That's a repositioning of the global financial infrastructure, and we're right in the middle of it. But of course, if you're watching CNBC, you're hearing about NVIDIA's earnings or the 14th AI stock of the week. You're not being told that the backbone of the global monetary order is quietly being rebuilt. That's why you're here. You want to be ahead of the curve, not caught under it. Because by the time the mainstream admits there's a shift, it's too late to act without paying massive premiums or accepting lower quality assets. Now let's go back to the COMEX for a second. This month-over-month surge in physical deliveries is not normal. We've gone from watching a trickle of physical metal moving off exchange to watching a damn torrent. And it's not just size, it's the nature of the buyers. We're seeing non-bank entities taking delivery. That means it's not just bullion banks playing hot potato with warehouse receipts. It's real institutions, family offices, hedge funds, people who want to own it, not trade it. That distinction matters more than people think. Remember Michael Lynch's recent report about 526 gold contracts remaining open right before the last notice day? That wasn't noise, that's potentially historic. Normally you'd have a handful of contracts lingering, 10, maybe 20 at most. But when you have hundreds still open at that stage, it means the shorts are scrambling. It's not that they don't want to deliver, it's that they can't. They're short metal they don't possess. That's not a conspiracy theory. That's a market breakdown waiting to happen. It's fractional reserve gold trading at its most naked. And no, I'm not saying there's going to be a default tomorrow. But I am saying this is an early warning signal. These are the types of anomalies you see before systemic dislocations. COMEX used to be a paper game, and now it's rapidly becoming a physical battleground. The quiet panic you're seeing behind these delivery stats is telling you that confidence is deteriorating. Smart money wants control, not promises. Meanwhile, retail investors are still asleep. The average American couldn't tell you the price of an ounce of silver if you gave them 3 guesses. They're still being told by mainstream outlets that inflation is under control and the economy is booming. Yet every metric, credit card delinquencies, food inflation, rent costs, gas prices, says otherwise. The official CPI is nothing more than curated fiction. The real-world experience of everyday Americans says inflation is not 3%. It's closer to 10, maybe even higher in some metro areas. And this disconnect is why metals are still the most underappreciated asset class in the world right now. While tech stocks get all the attention, gold and silver are slowly being pulled up a hill by the most powerful players on the board. When the public finally catches on, when that realization finally punches through the fog of media misdirection, it'll be like a fire hose of demand hitting an already stressed supply pipeline. Let's also talk about premiums. You've probably noticed that premiums on gold eagles, silver maples, and junk silver aren't dropping, even when spot wobbles. That's a clue. Physical markets don't believe the spot price anymore. They're operating in a totally different reality. You've got dealers paying well over spot to secure product and clients willing to pay those premiums because they understand the distinction between price and value. That's the playbook for a broken market. When the physical side no longer trusts the price-setting mechanism, you're nearing a reset. And let me be clear, a reset doesn't have to mean fireworks and panic. It can happen subtly through a repricing of risk, through FX devaluations, through shifts in trade settlements. You don't need an announcement. Just watch what people are doing. Watch what the BRICS nations are stockpiling. Watch what wealthy families in Dubai, Singapore, and Zurich are quietly moving into. It's not crypto. It's not NASDAQ. It's gold bars and silver kilos, tucked away from the madness. The legal side is shifting too. We're seeing increasing support for eliminating capital gains on gold and silver at the state level. Texas, Wyoming, Utah, they've all made progress on monetary freedom, and if Trump wins and follows through on eliminating federal capital gains for gold and silver, it could supercharge the shift toward metals. Suddenly, owning gold isn't just defensive, it's efficient. It's a tax-advantage asset in a world that taxes everything else into oblivion. You think that won't move capital? You better believe it will. And if you're asking, why now? Because the system's core assumptions are breaking down. We've hit the part of the debt cycle where rates can't go meaningfully higher without blowing up sovereign budgets. But we also can't lower rates without igniting even more inflation. It's checkmate. And gold loves checkmate. It's the only asset that isn't somebody else's liability. It's the only collateral that doesn't require faith in a counterparty. This isn't about short-term moves. This isn't about calling a top or a bottom. This is about positioning for a world that looks radically different from the one we knew in 2015, 2020, or even 2022. Gold and silver are no longer quaint hedges. They are becoming the foundation of a new monetary regime, quietly, steadily, and globally. And you can either be on the bus when it departs or chasing it as it disappears over the horizon. So what do? You accumulate physical. You hold cash strategically, not because fiat is safe, but because volatility creates opportunities. You own top-tier miners with margin expansion and competent management. You study the juniors, but you don't chase. You move with intent, because the system isn't collapsing tomorrow, but it's changing permanently. And that change rewards those who planned, not those who reacted. The biggest deliveries in the history of the COMEX are happening right now. The most aggressive gold accumulation by central banks since the 1960s is happening right now. The public? Still distracted, still unaware. But for how long? You've got a window. It's narrow. It won't last. Use it.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.